YouTube, what up, what up, what up, what up? I'm gonna do something a little different here today. It's 5:21 in the morning, all right? 5:21 in the morning. And I'm just sitting here thinking, how can I make my portfolio better? How can I get more gains in my portfolio, right? Like a business. You gotta tweak the numbers. You wanna see growth, you gotta tweak certain things. So you might need some certain tools to make that happen, right? Because I don't know. I don't have the information. I don't know. So what I do, I just go on Google and I Google, you know, how to have a well-balanced portfolio. And this pops up. Now I was gonna watch a video, but I said, you know what, just go ahead on and read some. And I figure as I read some, I could record it and share with the people, right? Because they might not go read it on their own. But being that I'm doing what I'm doing, they know what I'm doing, and they feeling the vibes. I know they feeling the vibes. I'll go ahead and read this along with you guys. Because at the same time I'm reading, you learn, I learn, we learn. We learn together on the road to riches. We learn the different tools that we need to put in our toolbox to get to the road to riches. Because it's not easy. It's a bumpy road on the road to riches. We have to unlearn what we learn and put some new stuff in our brain. Some stuff like this. Six asset allocation strategies that work. Let's go. BFC, LaShawn Wiggins. Let's go. We gonna get at it. All right. Let's go. Here we go. We're gonna turn the music down a little bit. You know what I'm saying? Just a little bit. Yeah. Let's go. All right. So again, I want to fix my portfolio. I want to have my portfolio balanced. Okay. Let's go. Asset allocation is a very important part of creating and balancing your investment portfolio. After all, it is one of the main factors that lead to your overall returns. Even more than choosing individual stocks, establishing an appropriate asset mix of stocks, bonds, cash, and real estate in your portfolio is a dynamic process. As such, the asset mix should reflect your goals at any point in time. All right, selector, we want to rewind a bit. Can I beat monsoon stop? Below, we have outlined several different strategies for establishing asset allocation with a look at their basic management approaches. Okay. Let's read the key takeaways real quick. Asset allocation is very important to create and balance a portfolio. All strategies should use an asset mix that reflects your goals and should account for your risk tolerance and length of investment time. A strategic asset allocation strategy sets targets and requires some rebalancing every now and then. So y'all remember how I was saying, like, when I make 1,000, I'm gonna rebalance. I'm gonna reorganize my portfolio. How I have it set. I'm gonna probably put like 5 positions of 2 or 10 of 100. I haven't decided yet. Okay. Ensure asset allocation may be geared to investors who are risk averse and who want active portfolio management. Okay, let's go. Strategic asset allocation. This method establishes and adheres to a base policy mix, a proportional combination of asset base on expected rates of return for each asset class. You also need to take your risk tolerance and investment time frame into account. You can't set your targets and then rebalance your portfolio every now and then. That's what I'm about to do. A strategic asset allocation strategy may be akin to a buy and hold strategy and also heavily suggests diversification to cut back on risk and improve returns. Now that's what I'm doing. You see, I'm already doing that. A strategic asset allocation strategy may be akin to buy and hold strategy and also heavily suggests diversification to cut back on risk and improve returns, baby. Come on, I'm doing that already. Let's go. For example, if stocks have historically returned 10% per year and bonds have returned 5% per year, a mix of 50% stocks and 50% bonds would be expected to return. Ooh, that's deep. Hold up. See? You gotta write that down, baby. I like that. So you want. Wow. Okay, so I gotta learn that. You see? So you could. Ooh. All right. See, y'all hear me? This is live. I'm gonna go back to that. But before you start investing, you should first read if you can't make money in stocks. Okay, whatever. I'm new, yeah, shit. I'm already making money. All right, I'm trying to find some new shit. Consistent weighing asset allocation. Strategic asset allocation generally implies a buy and hold strategy, even as the shift in value of assets causes a drift from intentionally established policy mix. For this reason, you may prefer to adapt a consistent weighing approach to asset allocation. With this approach, you continuously rebalance your portfolio. Mute. Sorry, for a reason you prefer for example, if one asset declines in value, you will purchase more of that asset, and if that asset value increases, you would. Damn, that's what I do already. All right, so basically what they're saying is, you guys see that I do that in my videos, okay? Because I invest in well-established blue chip companies, when it goes down in my portfolio, I attack it, okay? When it goes down in my portfolio, I attack it. Why? Is when it goes back up, hello. So I'm doing that already. That's good. There are no hard and fast rules for timing portfolio rebalancing under strategic or consistent weighting. You know the fuck that shit. I get tongue tied with the asset allocation. But a common rule of thumb is that the portfolio should be rebalanced to its original mix when any given asset claims more than 5% from its original value. So that means I should have been sold my other position. Because that shit been past 5%. Okay, so 5% at a time. All right, let me write this down. See, even me, I write stuff down. And even though I've been trading for all these years, I still write stuff down. Because you just gotta do that. You gotta always take notes, always learn. Every day, look what time it is right now. I didn't even go to sleep yet. But I gotta go to sleep soon because the market gonna open at 9:30, and I might sell that position I have because I'm up like I think $40 or $50 in it. And I'm gonna find something else to put it in. I'm gonna take probably out of my profits. I'm gonna put when it comes like a percentage, and then reinvest the rest back. You know what I'm saying? I just want to see it. I want to see like, yay, this is my shit. All right. So what am I writing down now? Oh, can be described as my strategy to manage this. Did I? See, I don't know if I missed what happened here. Consistent. I was reading over here, right? 5%. All right. I'm gonna try this out for like. I'm probably starting next month. trying for like a week or two, see what the results are. Because right now I'm trying to do 50% a week. That's what I'm doing right now. So I don't know. We will see. All right, moving forward. Okay. Tactical asset allocation. Over the long run, a strategic asset allocation strategy may seem relatively rigid. Therefore, you may find it necessary to occasionally engage in short-term tactical deviations from the mix to capitalize on unusual or exception. This flexibility adds a market timing component to the portfolio, allowing you to participate in economic conditions more favorable for one asset class than others. So basically, what this means, like, you have your portfolio, right, and it's just doing its thing, and then all of a sudden, like, some news could come out of something, and then it just changes the everything about that position. Okay, it could shoot up, it could shoot down, and basically, I already do this, so yeah. Tactical asset allocation can be described as a moderately active strategy since the overall strategic asset mix is returned to when desired short-term profits are achieved. This strategy demands some discipline as you must first be the hell? I don't know what that was. This strategy demands some discipline as you must first be able to recognize when the short-term opportunities have run their course and then rebalance the portfolio to long-term asset positions. Dynamic asset allocation. Another active asset allocation strategy is dynamic asset allocation. With this strategy, you consistently adjust the mix of assets as market rise and fall, and as the economy strengthens and weakens. With this strategy, you sell assets that decline and purchase assets that increase. Okay, so what does this mean? This means knowing your different sectors. Okay, so let's say, for example, transportation, uh, consumer staples like toothpaste and stuff like that. All right, let's say, so like, let's say there's a lockdown and no one going outside, no one's driving. Okay, the money in that field is going to go down, whereas the toothpaste stuff is going to remain because more people going to be home, and they just always sell. Knowing your different sectors, okay, you can know where this, you can bounce around, and that's what I'm starting to study. I'm starting to study the sectors. That's why I'm even doing this right now. This makes dynamic asset allocation the polar opposite of a constant waiting strategy. For example, if the stock market shows weakness, you sell stocks in anticipation of further decreases, and if the market is strong, you purchase stocks in anticipation of continued market gains. Insured asset allocation. With an insured asset allocation strategy, you establish a base portfolio value under which the portfolio should not be allowed to drop. As long as the portfolio achieves its base management, relying on analytical research, forecast judgment, and experience to decide which securities to buy, hold, and sell with the aim of increasing the portfolio. All right, so basically, I'll do this right now. With my strategy that I use, investing in very well established blue chip companies, my portfolio hasn't go down when I started Cash App. It just only go up. I just keep mixing around, and dollar cost averaging. I like this, man. I mean, I'm not a good trader now. If the portfolio should ever drop to the base value, you invest in risk-free assets such as treasuries, especially T-bills. So the base value becomes fixed. At this time, you would consult with your advisor to really get asset parameters. All right, so we're gonna T-bills. We gotta look into that. What are T-bills? You gotta learn that. Take notes, right? T-bills. I'll look that up later. What are T-bills? Market low. I love this stuff. Insured asset allocation may be suitable for risk-averse investors who desire a certain level of active portfolio management but appreciate the security of establishing a guaranteed floor below which the portfolio is not allowed to decline. For example, an investor who wishes to establish a minimum standard of living in retirement may find an insured asset allocation strategy ideally suited to his or her management goals. All right, we got integrated. The bottom line. Okay, now we almost finished. All right, we almost finished, boys and girls. With integrated asset allocation, you consider both your expectations and your risk and establishing an asset mix. With all of the strategy mentioned above account for expectations of future market returns. Not all of them account for the investor's risk tolerance. That's where integrated asset allocation comes into play. This strategy includes aspects of all the previous ones, accounting not only for expectations but also actual changes in capital markets and your risk tolerance. Integrated asset allocation is broader asset allocation, but it cannot include both dynamic and consistent blah 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 blah. I don't know. You understand what that shit means. Some stuff is like, hey, the bottom line, asset allocation can be active to varying degrees of strictly passive in nature. Whether an investor chooses a precise asset allocation strategy or a combination of different strategies depends on the investor's goals, age, market expectations, and risk tolerance. Keep in mind, however, these are only general guidelines on how investors may use asset allocation as part of their core strategies. Be aware that allocation approaches that involve reacting to market movements require a great deal of expertise and talent in using particular tools for timing these movements. Perfectly timing the market is next to impossible. Yes, it is next to impossible. You heard that, guys? It's next to impossible. So make sure your strategy isn't too vulnerable to unforeseeable errors. Man, y'all know I forgot to put the music back on. It's crazy. So what you guys like? Comment below. Music or no music? I like music. All right. So you guys, that took about what? That's about like a 8-minute read. I was talking a lot. But you got to do this. If you want to be playing with the big boys, if you want to get rid of the fear factor and make investing very fun with a little bit, some adrenaline going on here and there. But if you want to make investing fun and get rid of the fear, okay, remember what we said about the fear. We're going to take our left hand, we're going to take our right hand, we're going to put it together. First, we're going to put it in front of us like clap, clap. Then we're going to hold our hands together. You're going to make your back, your palms to each other, okay? Then in front of you got the word fear, F-E-A-R. I want you to put your hands in between the E and the A and push that bad boy to the side as hard as you can and walk through that bad boy. That's what this does, okay? This gives you the ability to get rid of the fear by always consistently self-improvement. Consistently self-improvement all the time, no matter what time it is. The Sean Wiggins, BSC. Until next video, which is about 1 minute. Let me stop. In 2 minutes.